How could a trader avoid multicollinearity using technical analysis?
So this leads into one of my favorite stories. Many years ago, I was at an investment conference, and a fellow came up to me with a printout, a chart printout. And he had a printout of price and Bollinger Bands and such like that. And underneath it, he had like 9 indicators, um, you know, all stacked up. And he looked and he said, so, you know, we came down and we tagged the lower band and we had this divergence, and I have 9 pieces of confirmation. But the trade failed. How can that be? You know, 9 pieces of confirmation. And so I sat with him for a while and I worked it out. Each of the indicators that he used was basically the same indicator. They were all various forms of momentum indicators. And so they all gave the same result. So instead, he thought that he had 9 independent indicators, but what he really had was the same indicator in 9 variations. You correctly identified the problem. It's called multicollinearity. It means they're all related. They're all linked together. So the bottom line is there was just 1 piece of confirmation and not 9 pieces of confirmation. So he had a false sense of confidence when he entered that trade. And of course, he entered that trade because of that sense of confidence with too much leverage and too big a position, and so on and so forth. So it was a real disaster for him, but it didn't need to be. What I like to suggest is that people use different kinds of indicators, like a momentum indicator, a trend indicator, a supply-demand indicator, maybe a volume indicator, something along those lines. Really different types of indicators.